Good afternoon, everybody. Happy Saturday to you. And it is time for this week's Eco Investment Update. It is Saturday, the 25th of April, 2020. And I hope your weekend is off to a good start. It sure has been a nice one here. It's nice and warm now. I think we finally chased the rainy season away. Big question on everybody's mind, and it continues to play out over time, is things have been pretty stable on the market since we bottomed on March 23rd. And we've rallied something on the order of about 50% so far off of our low of 1850. 50% of recapturing the ground lost. From 29.5 to 18.2 would be something on the order of 11,600 or something. We've now clawed back 50% of that, bringing us up to 23,850 would be the 50% point. And I think we closed somewhere near there, having earlier in the week touched at 24,200. So pretty close, right around the 50% retracement point. Now, what does this mean going forward? Well, first of all, we have unprecedented Fed action. So are we in a sucker's rally, or are we going to go on to new highs? We certainly see the NASDAQ, the tech-heavy index, is performing beautifully with Amazon and Netflix, two heavyweight components that are really causing the market to charge higher. There's quite a few tech-heavy, biotech heavy companies, whereas the Dow Industrial Average and the S&P 500 tend to be more weighted with old line companies, a lot of old manufacturing companies, consumer good companies. So we can get a difference between the performance of the two indexes, and the NASDAQ tech heavy index has been performing much better. Question is though, do we continue to rise? Are we in for something more severe, and what would that be? Well, we're going to put up a few charts today and examine them looking at 1929 and today, because in 1929, from November 15th until sometime in early April, there was a 50% rally also, and it came to be known as the ultimate suckers rally, because once it had regained 50% of what was lost in the crash of September, October, November of 1929, the market then proceeded down to a point in June, July 1932 where it lost 90% of its value, 90% of its value, compared to the peak in 1929, and that peak was not reached again until about 1958 or so. It took a long time to get back to that peak. The GDP was cut dramatically by about a third. Unemployment went up to 25%. We know a lot of the statistics of the Great Depression, but where do we stand today? Where do we stand in terms of that? Well, we certainly have unemployment, which is skyrocketed initially here. Okay, well, at a much faster rate than the 1929 plunge. We have businesses shuttered here. I don't know, some thousands, tens of thousands of businesses shuttered. And we're having our government shoveling deficit spending in like there's no tomorrow on a federal level. They did not have that in 29 through 1932. Let's go ahead and look at some of these charts, and then we'll talk about some of the things that, as you're looking at these, we'll point out some of the salient features on them. I'm not a chart maker, so bear with me. I'm going to attempt to do a voiceover in the movie maker here. So, okay, let's look at some charts. On our first chart here, you'll see a mini version of the crash of 1929 from September 3rd, 1929 until the end of what they called the suckers rally in April of 1930. On the right-hand side, you see 2020. Which has the large drop, and then the question is, of course, are we in a suckers rally of the magnitude of 1929. Now, in both of these cases, we had very severe drops. We had a 48% drop in 1929, and we had a 38% drop in 1920. So far, we have had about a 50% decline at 3850 would be 50% of the 23,850's 50% of decline from the bottom in 2020. And in 1929, we had an equivalent 50% rise. So in both cases, will the parallel hold? It's really hard to say. But let's look what happened after this sucker rally was ended in 1929, 1930. We'll look at that in a minute, but I think that you'll agree, looking at the parallel between those two charts and those two, both, there was no doubt about it that both of them were crashes in the extreme, and they instantly riveted the attention of the world worldwide on crashes that were occurring everywhere in 1929 as well as in 2020. We just happen to have the overlay of the coronavirus on top of that, which makes it almost like a smoke screen back there. You have to bear in mind that in the early 1930s, every prior collapse had been followed by, well, usually within a year or so, a rally and a recovery to a more prosperous era. So it was the expectation of people that were buying in that so-called suckers rally that, well, this will just be another garden variety. Let's go back and look at the history books. Yeah. Everything should be okay after about 9 months a year. I might as well just buy in now and be an early bird and reap the returns in the stock market from being first on the scene after that arguably very financially bloody fall. Well, of course, we know what happened afterward was a persistent and painful, one of the most horrendous declines. The crash was done. And I will tell you again, if people expect a recrash or things like that, those are extremely rare. Those events in a short period of time where you have a 30, 40, 50% loss in values in a matter of a couple of weeks, they're rare. But the next chart we'll look at shows the grinding decline from April of 1930 on to June of 1932. Let's take a look at it. This in no way conveys the pain of those years between 1929 and, really about 1940. It was a very painful time. We can see from the top of that suckers rally, I have sucker rally ends right at that one point there. And from that point on, the market just went down with periodic rallies that would last a month or two, then another leg down, another leg down, another leg down, until by June, July of 1932, the market had lost 90% of its value. You want to talk about people being demoralized, and out of that, the New Deal was born. The last chart we want to look at today shows the volume. You don't find many statisticians that are even able to find market volume these days on the exchange, and that's the amount of buying and selling that's taking place. And if you look at the blue on the bottom, you'll see when that big plunge came straight down from the top off the chart of the crash, you'll notice that the volume spiked up dramatically. From the left-hand side of the bottom, you can see it was up and down, and then all of a sudden, boom. When the crash started to occur, the volume exploded on the New York Stock Exchange. But the thing to notice now on the right-hand side, after bottoming out at that low point of 18,250 on March 23rd, look at the way the volume has gone down at an angle from that peak. It's starting to descend as price rises. Now, that's a very negative indicator. Normally, volume follows price, and it confirms the trend. If it's going down, then rising volume on the down. If it's going up, you want to see rising volume on that. And here we have the opposite. We have volume, which is drying up as prices are rising. That means the enthusiasm for buying as prices go up is declining, not increasing. So, looking at those charts and comparing to 1929, 1933, where we also had declining volume on that sucker's rally. Why? Because people were less confident to buy because the news started going bad. Back then, though, the news flow was not nearly as negative as it is today, and yet we've rallied 50% off of the low of March 23rd. Now, are things going to improve here? I've always said behind the smokescreen, I hate to call it a smokescreen because of course it's directly impacting many lives in a horrible way. And for that I am truly sad, the coronavirus. But underneath we need to remember that in August 14th of 2019, we had that yield inversion between the 2 and the 10-year notes, which signaled that a recession was coming long before there was any discussion or knowledge of anything associated with something called the coronavirus. So do bear that in mind. Much like you need to remember this too, in 1929-30, the expectation was things would get back on track, things were going to be good, the fundamental economy is sound, Ford Motor Company's pumping out cars, everybody's still buying consumer goods to a lesser extent, but recovery will come. Herbert Hoover beat the drum that confidence, we need to have confidence. You're going to hear that word so overworked in the next 5 years, if this in fact is a sucker's rally and we're going down to probe greater depths here, you'll hear that word a lot. Question is, how rapidly can things recover? And can it recover to the extent that employment can rise rapidly again? Or will we be in a situation where we have rising unemployment for a number of years as all the dislocations of this epic collapse here have caused people to shutter businesses, have to get loans, lay people off? It's been a real mess, and it's happened fast. Wham! Just like in 1929, and it came out of the blue, and it just slammed people. Just like in 1929, nobody could believe that things wouldn't get better in the future, much like we have that belief today. And nobody could quite figure out why it happened. Conveniently, we have this terrible thing called the coronavirus to pin it on. Back then, it was even more bewildering to see what the factors were. Economists studied that for years and years, and they still argue about it today. They'll argue about today the economics versus the pandemic. It'll certainly be something for discussion. But that's our discussions end today. The comparisons of 1929, that rally that occurred from mid-November to April of 1930, that 50% suckers rally. Are we having a suckers rally today? And is it near its end? Well, if history is to be a guide, and most things tend to happen at the 50% level, we shall see coming up. My bet is if I was betting on things, I'd be pulling a few chips off the table right now. Okay, thanks for watching today, everybody. Thumbs up are appreciated, and if you enjoy the content, please share it on your social media. Draw your own conclusions. As one news source says, I report, you decide. Thanks for watching, and please subscribe if you're not subscribed.